Yeah, welcome, ladies and gentlemen, to a new online interview here at Commodity TV. And today, I have the pleasure and honor to speak with, I would say, the mining investment legend, Rick Rule from Rule Investment Media. Rick, good morning to Washington State. Thank you very much for taking the time for the interview here. Yeah, and welcome to the show.
Well, good afternoon, Germany. It's a pleasure to be on with you.
Thank you very much. So, Rick, if I be honest, originally, when I made my homework here for this interview, I wanted to start with gold and silver, the spike in the silver price and all that stuff. But yes, since we are seeing a spike in oil today, maybe we should start with this theme. And yeah, we can follow up here on our last interview, which we did at Resourcing tomorrow at the beginning of December in the London conference. And there you told me that you are investing in, or you did invest at that time in hated commodities, by which you meant at that time, oil and gas. And I would say that was truly a great decision at that time. Also, of course, it was not foreseeable that it would spike at this short period of time now because of all that stuff in the Middle East. So that comes to my first question. How do you assess the current situation in the Middle East, especially the importance of the Strait of Hormuz?
Well, the price response that you've seen in oil answers that question. 20% of the world's crude, but more importantly, 50% of the world's export crude flows through the Straits of Hormuz. And when I say crude, I've made a mistake there. A substantial part of the world's supply of liquefied natural gas, 30% of the world's helium, and an important part of the world's petrochemicals and nitrogenous fertilizers also flows through the Straits of Hormuz. Part of my thesis around oil and gas for 30 years has been the fact that the oil market is very prone to strategic disruption, war-related destruction. That wasn't the heart of my thesis when you and I visited. The heart of my thesis when you and I visited was a much longer-term scenario that involved the systemic underinvestment by the global oil industry in sustaining capital expenditures. So I want to draw the contradiction, if you will, between the price spike that we've just seen, which, as you suggest, was not easy to forecast, and I didn't forecast it, and the reasons that I invested in oil. In direct answer to the question, I'm not a geopolitical analyst or a political analyst, and I don't know how long the circumstance between the United States and Israel and Iran continues, nor do I know much about the Iranian military capabilities with regards to shutting down the Straits of Hormuz. So if that's where the next question goes, probably I have to duck it.
You are right. We are not political analysts. We are experts in commodities, and you already mentioned it. It's not only about oil and gas. It's also about sulfur. It's about other chemicals, which are important for nickel and copper processing and all that stuff, which could also have an impact here now on all of the production producing miners in the entire industry. So what are your feelings about this stuff? So maybe also about fertilizers. It's a lot of fertilizer stuff, or about the chemicals are coming from the Middle East and are going through the Strait of Hormuz. So that's could be a heavy problem for the entire mining industry.
It is a problem. It's particularly a problem in the context of the ongoing dispute between Russia and the Ukraine, which is to say that another large producer of sulfuric acid and sulfur, as an example, and energy is Russia. And the fact that supplies from both Russia and the Persian Gulf are constrained simultaneously is in fact a problem. As I say, I don't know how long that problem lasts, I think ultimately, uh, what this circumstance will lead to is a continued diversification of supply, which is to say the Chinese and the Japanese in particular will look at their continued reliance on Persian Gulf export crude and understand that that's structurally unsound for them. And I think that you will see the whole of East Asia invest directly into productive capacity around the world, which probably lowers the oil industry's cost of capital and over 5 or 6 years maybe reverses the dearth of sustaining capital investments that we've seen. In the very near term, I suspect this is a news trade. And to the extent that I had speculative positions uh, in oil and gas, in sulfuric acid, in fertilizer, I would be selling. News trades are usually hyperbolic spikes. And as we saw earlier this year, the parabolic charts, like the chart we saw in silver, usually resolve themselves. The backside of that parabolic chart is just as steep as the front side, but much less fun if you're long. So I'm in this odd paradoxical position where my own investments in most of the high quality commodity producers are positions that I took for the 3 to 5 year time frame. And as a consequence of that, I'm loath to sell them because I had anticipated the price hikes that we've just seen taking place structurally over 5 years. Were I a trader, I would likely be taking the gains that have been offered up to me in a lot of things. When you and I talked last, I was enthusiastic about the big U.S. multinational producer, Exxon. It was easy to love Exxon at 95 or 100 US dollars. It's much less easy to love Exxon at $175. When I look at my portfolio, I'm amused as to what it's done for me, but it sort of doesn't matter in the sense that I have no interest in selling it currently. Given that I have no interest in selling it, it would actually serve my interest to see it back at 100 so I could buy more. But I realize that I'm different than many of your subscribers who have a shorter term and perhaps a less strategic and more tactical technique for investing and speculating.
What are now your favorites in the oil and gas sector? What would you say?
Well, until very recently, I didn't feel there was any need to take any company risk. I thought that there were such large structural imbalances in oil and gas that one bought the biggest and the best. Exxon is the biggest and the best. I owned a little bit of Chevron. I didn't own the European names because I felt that the nexus between the European states and the European oil firms were so large that they were inefficient producers. Um, I owned a little bit of Petrobras and still do as a speculation. And then I owned a basket of Canadian mid cap companies because I thought that they were relatively cheap compared to their US peers. I thought they were cheap because of political risk, and I thought that the political risk in Canada was diminishing. In the very near term, it looks like I was right. Very recently, I've increased my speculative focus on oil and gas. Uh, as you rightly pointed out, I love hate. And I looked across the oil and gas sector and I said, what if anything is hated? Small cap stocks, micro cap stocks are hated. Okay, I better look at micro caps. Conventional exploration is hated because the money that's left in oil and gas is going into shale plays and basin centric development plays. So I better do conventional exploration. Offshore and deep water is hated. There's been a dearth of exploration there for 15 years. So I better look offshore and in deep water. And emerging and frontier markets are hated. All of the money is coming into the United States and Canada. So I have assembled a portfolio of 5 small companies involved in conventional exploration, mostly offshore, in jurisdictions that most people either can't spell or couldn't find on a map. I'm not going to name names because I'm still building my position. And the last thing I want is 60 or 70,000 German competitors in those same markets with me.
Okay. Yeah, I understand this. But as we say, one man's loss is another man's gain. It's a good bridge to my next question. The sharp rise in the oil prices, should it be sustainable? Is likely to bring alternative forms of energy production back on the table, I believe. So, which brings us to the topic of uranium and the uranium sector. So the expansion of nuclear energy is likely to intensify in this area, I believe, and especially since Europe is very, very dependent on LNG. What's your feeling about this?
I'd rather ask you the question. You're German. Um,
Yeah,
I,
we killed all our nuclear plants, so I was not a fan of Mrs. Merkel's decisions, but yeah, I leave it with you.
if if the winds of political change would appear to be blowing in nuclear's favor around the world. The example would be the decision by the Japanese, the victims of Fukushima, to re-energize their nuclear fleet. This has happened slowly, but public opinion in Japan, that is to say, the polls in Japan, have swung from 65% of the population being opposed to nuclear to 70% of the population being in favor of nuclear. In my own country, in the United States, which has been closet anti-nuclear for a very long time, in Washington, D.C., in the capital, speculators in uranium like myself have gone from being vilified 5 years ago to the point where they want to subsidize us now. That's a pretty wild change. And so we're seeing a bunch of things in the nuclear space. The first thing that we're seeing in terms of the balance between supply and demand has been that plants which were scheduled for shutdown are not being shut down. This increases demand immediately because these plants don't have to be built. And their consumption was modeled by most analysts, myself included, as ending in 2026, 2027, 2028. This is immediate demand. The second source of demand has been and continues to be the incredible spate of new plant construction, particularly by the Chinese, but really occurring all over the place. These plants need to be fueled, and increasingly, in order to obtain the financing necessary to build them, they need to lock in supplies for long enough to amortize the loan, which is to say, in the contract market, a Chinese plant, as an example, which has a 20-year amortization of its loan, needs to lock in 60 or 70% of the required supplies over 20 years to amortize the loan, which means in the uranium business, unlike any other commodity business in the world, in the contract market, you can lock in both quantity and price. In every other commodity market in the world, you are a slave to the spot price. One more part to that. Sorry for this long-winded answer, but you asked me I'd say a structurally important question. I was not able to attend the World Nuclear Association meetings in London, but I have been fortunate enough to be able to play some of the recordings and read some of the transcripts. And one thing that struck me was the supply discussions. Supply is, of course, very opaque, controlled by traders, utilities, national companies, stuff like that. The estimate from the dais at the World Nuclear Association was that there is about 200 million pounds of finished above ground supply, not fabricated into fuel, but easy to fabricate into fuel. And if you take that 200 million pound number and you look at the production shortfalls, the production deficit, which is about 30 million pounds a year, according to some estimates, the suggestion was that there is 6 years of finished supply available to the industry. That causes people concern because there isn't a lot of replacement material coming onto the market to deal with this. What those commentators failed to notice, I think, was if that number, 200 million pounds, are right, 82 million pounds are owned in the Sprott Physical Uranium Trust, which is not available for sale. What that means is that having 6 years of surplus is wrong, that we only have 3 years of surplus. Now, I'm sure if the price went crazy and somebody viewed the 82 million pounds that Sprott owns as strategic, that if they bid a substantial enough premium, that the shareholders of Sprott would say, okay, take the pounds. But considering those pounds to be the equivalent of supply, usable supply, is wrong. The supply is much tighter. And we're seeing the reflection of that price tightness in the fact that in term contracts for delivery over time, the current year pricing is $6 to $8 above spot pricing, which tells you a little bit about the premium that users are willing to pay to obtain security of supply. Very bullish setup, very tough to play. Unfortunately, with regards to the sort of the 150 companies that purport to be in the uranium business worldwide, there might be 10 or 12 that are viable. And your listeners, the speculators, need to be able to do sufficient securities analysis to be able to differentiate between those 10 or 12 legitimate aspirants and then the 130 or 140 listings that are really truly flotsam and jetsam.
Okay, that's an interesting answer. Okay. So that brings me to my first question from one of our viewers. It's very specific. And it was what it concerns the extent to which you believe Nexgen energy could potentially be taken over in near future, maybe by Cameco or another major player. What are your feelings about that?
I think the list of potential bidders acceptable to the Canadian government, are very small. The idea that the Canadian government would allow, as an example, China General Nuclear, a logical bidder, pretty nil. And so I would suspect that were there a takeover for Nexgen, the only acceptable candidates in Canada would be Cameco, Westinghouse, perhaps Brookfield, the big Canadian infrastructure firm, which likely could finance a bid, Anglo Tech, or the huge multinational mining company BHP, which has a very, very, very large potash deposit, which they're putting into production in Saskatchewan. But I think it's important to note that now that Nexgen has proceeded far enough in the permitting, that armed with physical pounds to secure contracts, which they have, and the ability to enter into contracts, that Nexgen doesn't need to be sold. Nexgen could build this deposit themselves. Nexgen could, although it would be expensive, go to Westinghouse, and they could induce Westinghouse to build a mine and mill for them on a fixed price term. This would be expensive, but Cameco Westinghouse is in that business. They could, once they had timeframes and price locked in the contract market, contract sufficient uranium with investment grade counterparties that they could finance the construction of this mine themselves on their own balance sheet. It's important to note that despite the very high front end costs associated with putting this deposit into production, the structure of the uranium market is such that Nexgen does not need to be sold. My suspicion is that Mr. Courier, who's done an amazing job, would probably prefer to sell it. What he has had to do for the last 15 years is very different than what he would have to do for the next 10 building this thing. And I suspect that Mr. Courier knows that this build should really be handled by a builder, not by a financier. But I think he's in the unique position of being able to say to the bidders, we can sell to you. We might even like to sell to you. But absent the right price, we don't have to sell to you. I think that's very important. Were he in the copper business, where there's no long-term fixed price contract with users, he would have to sell. The only alternative to getting this deposit built, were it a copper deposit or a gold deposit, would be to sell to a major who could build it on balance sheet. But because of the structure of the uranium business, because he can enter into contracts for 20 or 25 years of duration with investment grade counterparties, and he can use those contracts as collateral for bank loans against a fixed price construction contract, he's in the unique position, like Paladin and a few others, juniors, that actually have the ability to build their deposits. Very different than any other commodity on the planet.
Okay, Rick, let's leave the uranium sector a little bit, but let's stay on the takeover and merger part. General question. Why aren't large gold companies like Barrick and Newmont, Agnico Eagle, why aren't they not using their exploding cash flows and earnings or profits to acquire more junior miners?
Because their owners aren't letting them. If you look back 20 years to the decade 2000 to 2010, you may recall that the gold price went up 6 or 7-fold, and the free cash flow per shares of the major gold mining companies declined. It took real skill to waste a 6-fold commodity price index and have your free cash flow per share decline. The management teams that presided over that dismal performance were uniformly thanked and excused. The investors behind the space have been constrained in terms of letting the major mining companies have the same access to free cash that they did in that dismal decade. That's going to change. The operating performance of these miners, the availability of credit and free cash flow, and I think ultimately the fact that this free cash flow will increase their market capitalizations and decrease their cost of capital will cause an M&A boom in the next 2 or 3 years. The criticism that the institutional investors will have of the gold companies will progress from, these guys are lousy stewards of capital and we can't let them invest. They have to return the capital to us to get it out of harm's way. It will change from, these guys aren't replacing production. They are cannibalizing themselves. They're shrinking. That was the ethos of that decade 2000 to 2010. As the share price of the majors performs, which will cause investors to see them as good stewards of capital as opposed to poor stewards of capital, what they're allowed to do and the cost of doing it, because their cost of capital goes down, will change the landscape.
Okay, we are now at the gold sector or precious metals sector, and as I wanted to know or wanted to speak with you originally about the silver price, let's dive a little bit into the silver market. Yeah, there were rumors that banks and investors couldn't be able or wouldn't be able to physically deliver their Comex contracts and all that stuff, which was not proven to be true to date. So, what's your current assessment of the silver sector?
Well, it points out the leveraged nature of Comex, where many days, 100 times the notional value of silver available for good delivery trades every day. Okay. This is a hugely, hugely, hugely leveraged market. But I think it's important for the retail investors who believe that a silver squeeze could be engineered to understand the nature of those contracts, understand the nature of Comex. Comex is an exchange owned by the dealers. They set the rules. What would happen if there was an actual failure to deliver would be that the Comex would declare force majeure, they would shut down the market, and they would cash settle at a price that they set. You will never, ever, ever catch the dealers short in a market that they own. So people need to understand that. Now, that cash settlement price might be very painful for them. It might be pleasant for speculators. But the idea that there would be a buy-in, the idea that the dealers would treat themselves the same way they trade their customers is wrong. That will never, ever occur. I need to say, too, that there were structural imbalances in the silver market, meaning that the silver price went up too fast for the inventories of good delivery in system silver to keep pace. The refiners couldn't keep pace. The further we go without a physical squeeze, the more non-good delivery silver can be processed by the refiners and can become good delivery. A second issue, popular in social media, has been that the Chinese have constrained exports, that the Chinese regard silver as a strategic asset, particularly around their solar industry. That's not strictly speaking true. The Chinese allowed their own citizenry to save in silver, but now they've decided to tax their same citizenry on that silver, sort of countervailing measures. But importantly, what they said was that they would prohibit the export of unauthorized silver, that only authorized dealers could export it. What that meant is that they passed out political favors to 40 of their cronies. They didn't constrain. They constrained. They didn't obviate the export of silver. They just made sure it was their friends who made the money, not everybody else. And finally, what I know parenthetically is that while there is a shortage of good delivery, investment grade silver in retail denominations, thus far there hasn't been a shortage of wholesale availability. My former employer, Sprott Inc., through the Sprott Physical Silver Trust, has been experiencing inflows of capital. And by its articles of incorporation, it can't accept deposit receipts. It has to have good delivery physical silver. And thus far, they have been able to buy that silver. So I would argue that in larger institutional denominations, silver is still available. It was not available through the LBMA for a while because paradoxically, the LBMA silver came to North America so that it could get out from under the Trump tariffs. And then the shortage developed rather than in the United States at the LBMA. And so silver has been going the other way. The longer that we go without a short squeeze in silver, a physical short squeeze, a failure to delivery, the lower the probability that that occurs. The refiners are working 24/7, taking non-good delivery silver, refining it, and turning it into LBMA Comex acceptable product. What is changing, of course, the thing that causes all this to occur is price.
It is, it is. Okay, when it comes to silver, Rick, then we have to speak a little bit about Mexico. So on the one hand, there was a killing of a very important, let's say, drug lord. On the other hand, we had the kidnapping and killing of or a murder of some miners. What is your view on this? And are you still invested in Mexican silver?
Yeah, first of all, I've been investing in Mexico for 45 years. I used to live on the Mexican border. And if you're invested in Mexico, you have to accept a certain amount of social chaos. I remember when a person running for president in Mexico, Mr. Colosio, was shot and killed in Tijuana. And this was many years ago, that resulted in the Bolsa, the Mexican Stock Exchange, selling off by about 45%. I hate to be cynical, but within 6 months, uh, the Bolsa had resumed its prior levels. What one needs to do if one's going to invest in Mexico is have a very, very thick skin about sociology and violence. And one needs to buy the sell-offs, buy the news. The second thing is that if you are an investor in silver and you aren't invested in Mexico and Peru, you aren't an investor in silver. You're a spectator. Yes, silver occurs in other parts of the world, notably Russia, Poland, some in the United States, some in Canada. But uh, if you are going to access true tier one deposits, deposits that inhabit the lowest cost quartile and the highest return on capital employed quartile, they're going to be in Mexico and Peru. It's as simple as that. These problems, the problems with regards to cartel violence in Mexico, I think are going to accelerate, particularly in Sinaloa, where the incident that you described occurred. Uh, the problem is compounded because there's a war between two factions of the same cartel for control of Sinaloa. Wars require money. One place to obtain money, uh, particularly given stronger U.S. border controls, is to shake down the mining industry. A separate issue is the Mexican government serious about confronting the cartels? And if so, do they have the tools? You may or may not remember, Tim, and your viewers may or may not, but 30 years ago, the Mexican government formed an elite anti-cartel task force. And after about 18 months, the elite anti-cartel task force transformed themselves into a cartel. Uh, I think that's indicative of the challenges. I, by the way, have stayed invested in Diesel Silver. Um, the events are not events I forecast, and by the time I woke up to it, the stock price was off 45%. This is, in my mind, the third best undeveloped silver deposit on the planet. My speculation is that the silver will stay in place long after the violence has subsided, and that Vizsla will continue to control that deposit. It's worth noting I could be wrong. It's also worth noting that after 73 years on Earth, I have the psychological and the financial wherewithal to take that risk. Other people may not.
Yeah, that's for sure. You mentioned it's Vizsla Silver, and yeah, they want to build a large silver mine in Mexico, and yeah, I think the Mexican state would also be interested in that this mine would be built and that they get also money out of it. Okay, let's come to the next topic here. Let's come to gold a little bit. What's your long-term outlook and what do you favor? Producers or juniors and developers? What's your feeling on this?
I think that depends on for who. Uh, I my 10-year outlook is that gold will maintain its purchasing power, absolute purchasing power, and fiat currencies like the U.S. dollar and the euro will lose 75% of their purchasing power. The consequence of that is that I save in gold rather than euros or dollars. So I'm long-term bullish on the gold price. I don't think that we're going to have the same rate of escalation that we enjoyed in 2024, 2025, but I'm bullish about the gold price. The consequence of that is that as an investor, I am comfortable with the Francos and the Wheatons and the Agnicos of the world. I also believe that, and I believe them to be effectively at the corporate level riskless. I think the gold price goes higher, and I think they have high quality operations. I think that they will be able to deliver. And so they are investment quality, set and forget investments. You will see better opportunities, but opportunities with more risk further down the scale. I can invest, not, that's the wrong phrase. I can speculate in the juniors because I've done it for 50 years. I know how to do it. I know how to assess the management teams, and I'm willing to do the work. I'm willing to take the risk. Most of your listeners, Tim, I suspect, would be better off playing the beta game, buying the biggest and the best of the best, and just letting the increase in the gold price in their domestic currency give them the gains that they would hope for. If you have listeners who are willing to do the work, who are willing specifically to spend at least an hour a month on each of their individual holdings, not listening to podcasts like this, but rather reading quarterly reports, uh, reading proxy statements, reading insider filings, there is more money to be made in the juniors, but there is more risk and more work than the average would-be speculator is willing to do. So they need to answer that question for themselves as to where the value is. Listen, the big guys uh, will, because of their size, their efficiency, and their trading liquidity, have higher share prices and hence a lower cost of capital. The tier immediately below that will have a higher cost of capital, which is to say a lower share price. And over 5 years or 6 years, that will either be arbitraged away by people like me, or the big guys will take over the little guys. That's what happens. Markets equalize. The single asset producers are viewed by the market correctly as riskier than the multi-asset producers, because if something goes wrong with their one asset, it cripples them. That discount goes away when they get taken over. By definition, a multi-asset producer that takes over a single asset producer erases the single asset producer discount. So there are arbitrage opportunities in that market. There will be horizontal amalgamations too, not a case where a big guy takes over a little guy, but a case where 2 or more little guys merge to create a big guy. There will be opportunities for producers to take over developers because they have a lower cost of capital, and they have more expertise at developers. And in the exploration sector, because high quality discoveries, say a snowline, are so rare that they will be taken over for eye-popping multiples. But in order to play that game, you have to take real risk and you have to work very hard. For most people, foregoing some of the gain and eliminating the risk and the requirement to work is a good trade. Most people should be involved in gold, Franco, Wheaton, and Agnico. Stop. Only those who are willing to do the work. They may self-select by listening to programs like yours. Only people willing to do the work should allow themselves to come down the quality trail in hopes of securing alpha as opposed merely to securing beta.
Okay, Rick, that brings me to another question of one of our listeners, which I think is very interesting. The question is the prevailing opinion that a ratio of approximately 50-1, so it's about a gold-silver ratio, 50-1 is fair or balanced, not outdated, given that silver is experiencing increasing demand from booming industries such as photovoltaics and automotive manufacturing. So is this old thinking about silver ratio, 51, 61, that's what we ever had and what we ever will have, is this not outdated?
I think the ratio is a factoid. I think that prices go to supply and demand, first of all, and they go to utility. The ratio of silver to gold in the Earth's crust has nothing in the near term to do with supply. And it has nothing to do with utility. So while I think that 15-1 is useful for generating fees and commissions and also for selling newsletters, I don't think it has much real-world implication. It's important to remember that most silver that's produced isn't produced by silver mines. It's produced by copper mines, lead mines, and zinc mines. And if you want to understand something about silver prices, rather than focusing on the relative abundance or scarcity in the Earth's crust, you have to look at production schedules of copper, lead, zinc, and laterally gold. 2, with the changing utilities of silver, which is to say its growing industrial applications and its relative decline to gold as a monetary metal, you need to take utility into consideration as well as supply. What people want is they want a one-size-fits-all ratio, a factoid, something like 15 to 1, to justify an action that would rationally require hard work and long calculation. So as I say, in the 50 years I've been in the business, that 16 to 1 ratio has been great for generating commissions and selling newsletters. It has had very, very, very little impact on rational analysis of the silver price.
Okay, that's a clear answer. That's great. Thank you very much for this. So we had now oil and gas, we had uranium, we had the precious metals, and there's one missing part for me. That's the energy metals, or let's call it base metals or battery metals. So where, copper is number one here. What's your assessment about the copper? As we have it on newsletters, every newsletter is selling now copper. What is your feeling about all this stuff?
In the very near term, we're experiencing, perhaps as a consequence of war, a global economic slowdown. And despite what the newsletters say, we're awash in copper. In the very near term, the physical copper market's in disarray. People have been hoarding it. People have been speculating. And parenthetically, society has copper coming out of every orifice. So in the near term, the outlook for the copper price, I think, and copper supplies is very bleak. Looking out 5, 6, 10 years, the opposite is the case. We have underinvested in copper for 30 years. I know, because I've been in the trenches. We've underinvested in development, we've underinvested in exploration, we've underinvested in processing, we've underinvested in every aspect of the copper business. And we can't make up for 30 years of absence in 5 years. At the London metals market, where you and I believe, last met, there was a very interesting paper delivered, I believe by Wood Mackenzie, that suggested that the biggest copper producers in the world need to invest 250 billion constant US dollars over 10 years. It's important to note those aren't nominal dollars, because the inputs in building copper mines are increasing at about 8% compounded. So 250 billion constant $2,025 over 10 years. Now, one problem with that is that they know where they're going to get 150 billion, but they're missing the last 100 billion. The second problem is that that's to maintain production at the current level. The difficulty with that, from the perspective of humankind, from the perspective of the consumer, is that current production is in a deficit, which is to say we're using more than we're producing. So in order to maintain the deficit over 2025 production levels, we need to invest $250 billion constant dollars. And that neglects the fact that copper demand on a global basis is increasing at 2% per annum. That tells me that there is nothing that we can do in the next 5 to 10 years to balance supply and demand. In the absence of balanced supply and demand, you ration by price. And I think that's what's going to happen in the copper space. Validation of that, by the way, occurred in the market very recently. The biggest and most solvent mining company in the world is BHP. Period, full stop. BHP just did a deal with Wheaton Precious, a company 10% of its size, where Wheaton Precious financed BHP. Specifically, they bought a silver stream for $4.2 billion. Now, this is very important to understand. It's important in a lot of senses. It's important to understand that precious metals production, but particularly silver production, that's wrapped in a precious metals product without being burdened by operating cost, capital costs, and stuff like that, trades at 15 to 20 times cash flow. While that same revenue, wrapped in a copper company, trades at 5 to 7 times cash flow. That's important to note. The streaming industry's cost of capital is probably permanently lower than the copper industry's cost of capital. So it makes perfect sense that a large part of that $250 billion that the majors require will come from pre-selling the gold and silver stream. That's very, very important to understand. And there's broad investment implications for that. But it also says, it also points to the fact that the capital stacks are going to change very dramatically. It points to the fact that the mining industry understands that the capital needs they have are insurmountable, and also that nothing that they can do is going to avoid having the copper price, having the balance of supply and demand settled by price over 10 years. The third thing it says, I think, Tim, is that we are dearly underestimating the value of tier one producing copper deposits, deposits with very long lives that don't have to be permitted because they're operating. They don't need to be built because they're operating. And they have mine lives that will allow them to be producing copper during that period of time when the copper supply is rationed by price. When we value these long deposits, Tim, what we do is we use a discounted net present value calculation. We discount the cash flows at, say, 8% or 10%. What that means is that cash flows that occur after year 10 are effectively valueless to the valuers, but a 30-year deposit after 10 years has the same net present value as it had on year one. And we don't value the tail. This tail will become enormously valuable in 5 years or 6 years or 10 years. And investors need to understand that. Speculators, people who have trauma holding stock over a long weekend, need not be concerned with that. But investors definitely need to take that into consideration. One other thing, sorry for these long-winded answers. The copper industry has noted that the inflation in construction materials and services is increasing at about 8% compounded, which means that a $10 billion US porphyry build today is an $11 billion build next year and a $12 billion build the year after. So when we talk about $250 billion being required, that's in constant 2025 dollars. There will be a scarcity of capital available to copper companies. From the point of view of a provider of capital, which is to say me, that's a wonderful thing.
It is. Okay. So second largest question, Rick. Let's come from copper a little bit to nickel, also an important metal or material for the automotive manufacturers and so on. You are living in Washington State, not that very far from the border to Canada, let's say that. And do you think that Canadian low-grade nickel projects, such as those from Canada Nickel, have a chance in this cycle, or do we need much higher nickel prices for such projects?
We need much higher nickel prices, and they stand a chance. The mining industry loves dumb money, and there's no money as dumb as government money. Both the United States and Canada will subsidize otherwise uneconomic deposits in North America because that buys votes. Absent dumb money, those deposits stand a chance 10 years from now, but not now. The next 18 to 24 months, we'll see the cresting of competition from lateritic nickel deposits, particularly at today's oil prices. One of the big inputs for nickel laterites is energy. And as you noted, those costs have doubled in the last 3 months. But at any rate, the competition from lateritic nickel decreases as the politics of Indonesia and the Philippines particularly require an accounting of the environmental costs around that production. One thing that hasn't been noted is that the cash costs of producing lateritic nickel have increased by 30% over the last 2 years. As this continues, and it will, the competition from lateritic nickels to traditional sulfide deposits lessens. The lesson 3 years from now, 5 years from now, is that high quality sulfide nickel deposits that weren't economic 2 years ago will become highly economic 3 years from now. And the low quality deposits, the very large deposits, the hourite deposits, as an example, in British Columbia, or the low grade deposits like Canada nickel, will become, quote, economic earlier, but only because of the stupidity of the voters.
Okay, good. Clear answer. Wonderful. I love this. So the final question, also from a viewer, and let's come away from the metals a little bit. How do you currently view the fertilizer market, especially potash? Are you invested in this sector, and what are your favorites?
I've been invested in the potash industry for a very long time. And that means that over the long term, I've had an extremely good experience. I have received far more by way of dividends than my original capital cost in Potash Corp of Saskatchewan. That obscures the fact that that stock, let's just say it's been up and down. It's been a character builder over time. I'm still invested, and I suspect that the sell decision will be made by my heirs. Uh, if we have a circumstance where the global community finds a way to engineer a peace between Russia and Ukraine, and supplies of Russian potash, the world's lowest cost producer, and Belarusian potash comes back in the market, that'll moderate the increase in potash prices. If it doesn't happen, if the current circumstance of geopolitical control of potash continues, then those Canadian deposits are absolute gems. There, because of the recent strength in the potash market, there has been a lot of investments in potash deposits around the world that are decidedly substandard, not tier one. A tier one deposit, in my book, has in situ recoverable reserves and resources in excess of $10 billion. It would be in the lowest cost quartile worldwide, including the Russian deposits, and the best return on capital employed worldwide, uh, meaning, including the Canadian deposits. By that standard, most of the things that you see in the junior market are junk. That doesn't mean that they won't attract a bid. It also doesn't mean that there needs to be peace. Uh, Let me rephrase that. There does need to be peace, but sometimes what you need is something that you can't get. A lessening of geopolitical concern and a lessening of hostility between Russia and Ukraine would be the key to a more rational potash market. And I don't know if we're going to see that.
Okay, so at the very last, I have to ask you about your top picks in the oil and gas, uranium, gold, silver, and energy metals sectors. And yeah, if you like to answer me this question, perhaps you could name one, let's say, bigger or larger, and one smaller stock from each sector that you currently have maybe on your watch list, and maybe give a brief explanation why this is your topic for the next.
In the uranium business, it would have to be Cameco. Kazatomprom is cheaper, but there needs to be some political resolutions in Kazakhstan, and they need to address the exodus of middle management from Kazatomprom before it became investable for a broad audience like your own. Cameco meets all the criterion. The stock has done very well. If the circumstance I see in uranium continues, the stock will continue to do very well. In the precious metals, I don't have one. I think you need to own the triumvirate, which is to say Franco, Wheaton, and Agnico Eagle. Someone who's willing to do more work can broaden their portfolio substantially. But to play the beta game, you need to play the best of the best. And those three are the best of the best.
Okay,
Uh,
those are was in the energy metals sector. Do you have something that you prefer?
I don't. I really don't. Among the copper producers, I mean, there isn't really a pure play that interests me. the most efficient producers are probably Rio and BHP, but they're iron ore companies and drag. You don't buy copper exposure with them. The rest of the copper sector, to me, doesn't give you a pure enough play. If you come down the quality trail somewhat and you look on a valuation versus growth metric, then I think you have to buy Ivanhoe. But Ivanhoe exposes you to lots of construction risk and lots of Congolese political risk. It isn't the sort of lower risk play that you would enjoy, um, in my precious metals sector picks.
Okay. Good, Rick. Thank you very much for this very, very long and outstanding insights here in your concrete events here in the commodity sector, in your feelings, in your assessment, and we would be very happy to have an interview update maybe somewhere in the summer, and to hopefully have here new information about all that stuff, and maybe also you are right as you were in December with the oil and gas sector. And let's have an update then.
I would be delighted to do that, and I would invite your audience, by the way, to contact me in the interim. And I'll give them an incentive to do that. Specifically, any of your listeners who go to my website, ruleinvestmentmedia.com, can list their natural resource portfolios there. And I will personally, for free, rank those portfolios, 1 being best, 10 being worst. I will review speculative portfolios, despite my advice to investors. I realize that ultimately the choice is up to the individual, and I will rate those. So if you send them to me by email, I will do that. Ruleinvestmentmedia.com, list your natural resource stocks, and I will rank them. Secondly, any of your listeners who would like to learn more about natural resource securities analysis could go to my other website, Rule Classroom, and join 17,000 other investors in using over 300 hours of recorded material, including Introduction to Natural Resource Investing, which is absolutely free. So ruleinvestmentmedia.com, I'll rank your natural resource stocks. Rule Classroom, I and others will teach you in over 300 hours of recorded programming how to do your own securities analysis in natural resources, absolutely free.
Wonderful. Rick, we will put all these links here into the video so that our listeners can join you and get taught by you and learn a lot more about the sector and about your feelings and your experience. Thank you very much, Rick. Thank you very much. Yeah, ladies and gentlemen, you heard it. There are always new opportunities for lucrative investments in the commodity sector. And I hope we were able to provide you a lot of new information here. And you should have a look on Rick's websites here, and also look on the hated commodities, as Rick always told us. And more important information before we finish here. More information could also be found in our battery metals, precious metals, and uranium reports at rohstoff-reports.com. You will also find the link here in the video. And therewith, I would say thank you very much and bye-bye from Switzerland.